A very warm welcome to all students to Mickey's classes. Today what we are going to cover is a part of the recording of transactions chapter. What we'll do is we'll do a practical example. So now we have already seen how to record a transaction. If there are any students who hasn't seen that video, I'll put it in the description box. Please check that video and then you can come and check this video out, because you'll need to know the basics before getting into this video. So let us start off. Okay, this is the example which is mentioned in page number 46 of the CBSE text. So if you remember, I have just covered all the steps in the last video, which I've already mentioned, but just to take you through the steps of double entry bookkeeping. So you have to read the transaction statement, which is basically what? Reading the statement. Okay. What is the next step? Identify the accounts which are involved. So by reading the statement, open the bank account at State Bank of India with an amount of rupees 4,80,000. We have to find out which are the accounts which might be involved. And as I've mentioned before in the other video too, this step 2 requires a bit of practice. Through practice, it will become so much more easier for you to understand which all accounts might be involved. Step number 3, categorize the accounts among the 5 categories. What are the 5 categories? I hope you all remember. The 5 categories are: any account can either be an asset or a liability or a revenue or a gain, a loss or an expense, and finally, if none of the other categories, it can also be capital. So step 1, read the transaction statement. Step 2, identify the accounts which are involved. Step 3, categorize the accounts among the 5 categories: assets, liabilities, revenue, gain, loss or expense, or capital. And the last one is apply the rules of debit and credit. So we'll check what is this final step all about. We've already covered it in the last video, but quickly let's go through. So as we've already discussed, it has to be any of these 5 categories, right? Okay, then what are assets? We've already covered that. Please check the last video if you want. Likewise for liabilities, capital, expenses and revenue. And this is used in the final step, which is the rules of debit and credit. Fine. So I just wanted to re-emphasize that we have already covered all the steps which are required to record a transaction. Now let us get to this practical example, which will help us understand the concepts a little better. Okay, so now to the practical example in page 46. What is the first statement? First statement is open the bank account in State Bank of India with an amount of 4,80,000. Now, what are the steps which are involved in this? Read and check the transaction statement given in the example that we have already done. What is the second step? Identify the accounts which are involved. Now this, as we have discussed even the last time, this requires a bit of practice, but let us go back to the statement. So now what are the accounts involved in this? We know that what has happened is this person, whoever is the owner, has gone and opened an account in State Bank of India. What would this be in the name of? This will be in the name of business, right? So an account has been opened in the name of the business and some cash has been put in. How much cash has been put in? 4,80,000. So you know, whenever cash is involved, cash will be one of the accounts. So we know one of the accounts which are involved in this first statement is cash. What is the other one? There's a bank account which has been opened. So the other account will be a bank. As I told you, you'll know more and more about which of the accounts are involved by practicing. So 2 accounts are involved in this transaction: bank and cash. Now, so the second step is done. So first step, is done. Second step, identify the accounts. Accounts are cash and bank. What is the third step now? Categorize the accounts among the 5 categories. And we know what can be the categories: asset, liability, capital, expenses or revenue, expenses or losses, or revenue or gains. Now, let us check one by one. Let's start with asset. What are assets? Assets need to have, I'm just keeping it short, assets needs to have these 3 elements. It should be a resource controlled by the business as a result of past events, and future economic benefits are expected. So let us check. So let's go to the whiteboard. Okay. Now let us check what all might be involved in this. So the 2 accounts which are involved, we have already discussed, is one is the cash account and the other one is the bank account. Okay. So let's start with cash. Okay. So if something is to be an asset, what needs to be there? What are the 3 elements which are required? It has to be a resource controlled by the business. Correct? Is cash a resource controlled by the business? Yes, it is, because the cash is in the bank account now, and the bank account belongs to the business. So automatically, this point is taken care of. Number 2, due to some past event. What is the past event? Do you think the past event is someone has gone and deposited this money into the banks, into the business's account? So due to some past event in this case is depositing the money. Depositing the money in the bank account, right? So this is also taken care of. Point number 3. It should be, do you expect any future economic benefits? The business has cash. So from cash, does the business expect any future economic benefits? It sure does, right? Because with the cash, the business can buy assets, which is an economic benefit, or make payments, that is again an economic benefit. So, and with cash, a lot of other things can also be done, right? So, which means cash has all the elements, 1, 2, 3, all the elements which makes cash an asset. So, cash is an asset. Okay. So, just to make it more clear, what are assets? This is what I had written in the drawing board just now. Control, it has to be a resource which is controlled by the entity, by the business, which means result of past events and future economic benefits are expected. If all of these elements are there, then it is an asset. So cash is an asset. Fine. Okay. Board again. So we have covered for cash. Now let us check which is the other account which is involved in the transaction. So the other account which is involved in the transaction is bank. Correct? The other account is bank, isn't it? So let us check if bank also fits the category of an asset. Let's clear this. Okay. So okay. So let us now check in the case of bank. Bank means a bank account. Is it a resource controlled by the business? It is, right? Because the account belongs to the business. So it is controlled. Due to some past event, what is a past event? Account has been opened. The account was opened. So that is the past event. So it also ticks the second one. Expect any future economic benefits. If the business has money in the bank account, can it use it for economic benefits? It can, right? Like in the case of cash, it can buy assets or make any payments. Correct? If there's money in the bank, you can use it for all this. All these are what? Economic benefits. So which means again, bank also fits the definition of an asset. Clear on this? So which means what? If you think about it, so both bank account and cash, both of these are assets. And these are the two accounts which are involved in the transaction in our example, right? In this example, in the first statement, there are two accounts which are involved. As we discussed, one is bank and the other one is cash. And both of them are bank as well as cash. Both of these are what we have found out. They fit the definition of assets. So now we are just left with the last step, which is step number 4. What is step number 4? So think about it. We have already covered step number 1, step number 2, step number 3. What has happened in step number 3? We have identified that both of the accounts are assets. Correct? So 1, 2, 3 done. Now the fourth step is left, which is apply the rules of debit and credit. Let's check what needs to be done there. Okay. So what do we have to do here? So we have to use these rules now. So we know that in this case, two accounts involved are cash and bank. So, and you always have to think of it from the business's perspective. You have to think of every transaction from the business's point of view, business's perspective, and not from the owner's perspective. This concept has already been discussed in another video. This is called as the business entity concept. Which means what? Business entity concept basically emphasizes the fact that a business and its owner are two separate entities. And we have to think of every transaction from the business's perspective. So, what has happened? Cash has gone out from the business. And where has the cash gone? Into the bank account. So the bank account, the bank balance has increased and cash balance from the business has decreased. And both of these are, we already know both of these are assets. Bank as well as cash are assets, correct? So let's check the rules for this row, assets. If asset increases, it has to be debited. What has increased? Bank. So which means the bank account has to be, the bank account here has to be debited. And again, assets, if asset decreases, what has to be done? It has to be credited. What has decreased? Cash. So the cash account has to be credited. So now we have completed, we have used the rules. The fourth step is also covered, but we need to know how to now make the entry. So I'll use the whiteboard for that to make the final entry. Final entry, we'll use the whiteboard. Let's clear the canvas. So which are the two accounts involved? Bank and cash. Bank has increased. So what we'll write? Bank account has to be debited, right? So we'll write it like this. Bank account debit to cash. So this is the way, this is what we call as journalizing or recording a transaction. This is journalizing a transaction, which is basically keeping record of a transaction. We'll learn the steps for journalizing and we'll cover this in detail at a later point. But this is the accounting entry which has to be made for the first example. Bank account debited to cash. And you see here I have not write DR means debited. But I have not written CR against this. CR is credited. But traditionally, the moment you put this 2 and you put it a little towards this side, you see bank starts from this point, but this entry starts from here. So it is inset like this. It doesn't start from the same point. And the moment the 2 is already mentioned, which means it is assumed that it's a credit. So you do not have to write CR, but you have to write DR. So bank account debit to cash. This is the what you call as the journal entry. Journal entry. I hope that makes it clear. So we have covered the first transaction as of now, and I've taken a lot of time, I know, so that you understand the basic concepts. We'll go a little fast with the rest of the entries. But now to the example. So the example, the second statement now. The first statement is already covered. Bought furniture for rupees 60,000 and check was issued on the same day. So we have read the statement. That is step number 1. Step number 2. What are the accounts? What is step number 2? Step number 2 is this we have done. Step number 2 is identify the accounts. Correct? So let's try and identify the accounts. Bought furniture for rupees 60,000 and check was issued. Whenever a check is issued, you know with practice, as I keep on telling you, you know that bank account is involved. The payment is not made in cash, but by issuing a check. So a bank account will be one of the accounts which are involved. The other account with practice you'll know is furniture. Other account is furniture. Okay, so we know that one account is furniture, another one is bank account. So for every transaction, there has to be a minimum of 2 accounts which are involved. That is why we call this system as double entry. Double entry bookkeeping. Fine. So the 2 accounts involved are furniture and bank account. Now we have covered step number 1 is done. Step number 2 is done. Step number 3, categorize the accounts among the 5 categories. Is an asset, a liability? This one. Is it an asset, liability, capital, expenses, losses, or revenue or gains? So we have to check it for 2 accounts, for furniture and for bank. So we'll check for these 2 now, furniture and bank. We already know that bank is an asset from the last example, right? So we don't have to check again. Bank is automatically an asset. How about furniture? Let us check. So if we go to the definition here and we are trying to check for furniture, is the furniture after it is purchased controlled by the business? Is it a resource controlled by the entity? Yes. Correct? Yes. Because it belongs to the business now. As a result of past event? Yes. What is the past event? It has been bought and the payment has been made. So as a result of past event. What is the third point? Future economic benefits are expected. So if you have furniture as a business, do you expect any future economic benefits? Yes, because you'll use the furniture, right? You can use the furniture, whether in your office, in your factory, wherever you can use it. So, which means furniture also fits the definition of an asset. So furniture is also an asset. It is just a matter of coincidence that till now, whichever accounts we have dealt with, all are assets. Okay. So, which means for our example 2, this one, again, the two accounts which are involved are both assets. Both are assets. When I say both are assets, what are assets? Both furniture and bank account. Okay. So, which means we have already covered step 3 also. We have categorized. So, both of them are assets. Step number 4 now. Apply the rules of debit and credit. Okay. Let's go to that page. Fine. Okay. So, this page. So, what happens is we'll have to check the rules for assets again because both furniture and cash are assets. Okay. And we have to think of all transactions from the business's point of view. Which business? Our business. When I say our business, the business which is keeping the records here. Okay. So furniture and bank account. Okay. Now furniture, what has happened? We have bought furniture, right? So furniture has got added. Assets, when assets increase, it has to be debited. So furniture, we have to debit. Fine. Bank account, we have made a payment, okay, to buy the furniture. So bank balance would have gone down. So an asset, when the asset decreases, what do we have to do? We have to credit. So now the entry will be, now you already know how it has to be written as a journal entry, right? So furniture account, debit, 2, you remember that? 2. So 2 means created. 2 bank account. This will be the journal entry. I know I have not written the amounts here. Amounts, but how the amounts need to be written is you write the amount for the furniture here, for the debit entry somewhere around here, and for the credit a little more towards the right hand side. Okay. So because when we discuss journal entries, I'll discuss at length how journalizing has to be done. So there's a format which has to be used. So we'll cover all that. Okay, fine. So let us now go back again to the example. Step number 3. Step number 3. What has happened here? So the business has now bought plant and machinery for the business for rupees 1,25,000 and an advance of rupees 10,000 in cash is paid. So the business has bought plant and machinery by paying some cash. And the moment you know the word cash is involved, which means it will be one of the accounts which is involved in this. Now we know that plant and machinery, the price is how much? 1,25,000. But the cash which has been paid is only of 10,000. What happens to the rest of the money? What happens to the balance? This 1,15,000 which has not been paid, what happens to this? So when you carry on business for a long time with a supplier, and in this case, I'm assuming that this Ramji Lal is a supplier for the business, for this business for long. So what happens is this part has not been paid. So Ramji Lal becomes a creditor for the business, which means Ramji Lal has to get some payment from the business. How much is the payment? He needs to get 1,15,000. And depending upon the agreement, after how many months or how many days that has to be paid will be determined. Okay. So now because we have bought plant and machinery, we know plant and machinery will be one of the accounts. Cash is the other account. Which is the third account? The third account will be, and you'll know with practice as I keep on repeating, will be of Messrs. Ramji Lal. Okay. So these are the three accounts which will be involved in this case. Now let's see what needs to be done with these. How to make a entry for this. How to keep the record for this transaction. Okay. So as we discussed, there are three accounts involved in this transaction. Three accounts involved in this transaction. Okay. What are they? The first thing is plant and machinery. The second one is cash. And the third one is Messrs. Ramji Lal. These three. Okay, these three are the accounts which are involved. Now we already know that cash is an asset. So we only have to check for plant and machinery and Ramji Lal. Okay, so let's check first for plant and machinery. We'll first check for assets. Is plant and machinery an asset? Let's check that. Okay, so we are trying to check for plant and machinery. We are trying to check if plant and machinery is an asset. Is it a resource controlled by the business? Yes, it is controlled by the business because it's been bought by the business. Correct? First point is correct. As a result of past events. Past event is what? The purchase which has happened and the payment which has happened, right? How about the third? Future economic benefits are expected. If a business has plant and machinery, what does it do? It will use in manufacturing. It will use the plant in manufacturing. Suppose the business is of production of cars. It will use this plant and machinery for manufacturing cars, maybe. Manufacturing or for production. So, manufacturing or production of cars, will it be a economic benefit? Yes. So, the third point is also covered. So, which means plant and machinery again is an asset. Right? So we are sure about this as of now. Let's go back. So what we have confirmed is plant and machinery also is an asset. How about this now? Ramji Lal. Okay, let's check. Let's again go back to the definition. Ramji Lal. So we have to make a payment to them. So let's check here. Is it Ramji Lal's account, is it controlled by our business? The the money which we have to pay to him, is it controlled by our business? Or the account rather, is it Ramji Lal, the account for Ramji Lal, Mrs. Ramji Lal, is it controlled by our business? No. So if any of these is a no, so which means this cannot be an asset. This account cannot be an asset. But let's check for the other points also. Result of past events. What is the past event? Past event is that we have bought some plant and machinery from Ramji Lal, right? That is the past event. The second one might still hold. Future economic benefits are expected. So are we expecting any future economic benefits because of the fact that we owe money, because of the obligation, Are we expecting any future economic benefits? No, because in fact, we have to make a payment. We have to make a payment. So, which means Ramji Lal cannot be an asset. Actually, we should have just checked this point, and the moment we know it is not controlled or any of these is a no, which means this cannot fit the definition of an asset. So Ramji Lal is not an asset. So let's check now. Is it a liability? Let's check. Present obligation. Is it a present obligation for us? What is an obligation? Anything which we are bound to do, which we have to do. So there's a present obligation. There's a present obligation, right? We have to make a payment. Don't get confused by this word present. Doesn't mean that the payment has to be made immediately, but at some point we have to make the payment. But the obligation is present, which means it is already there that a payment has to be made. At what date? That might be in the future. So the first point is correct. Okay. As a result of past events, what is the past event? That purchasing of the plant and machinery, because of which we have to make the payment to Ramji Lal. Future outflow of resources are expected. We are always thinking from our business's point of view. Because of this, is there any outflow which is expected? Yes. What is the outflow expected? Money. So we have made a cash payment of 10,000, but the plant and machinery cost us 1,25,000. So this balance of 1,15,000 still has to be paid. And this is what is the expected outflow. Correct? So which means this Ramji Lal fits the definition of a liability. So Ramji Lal is a liability. Okay. So we know by the rules that in our case, plant and machinery has come into the business. So it's a plus. Correct? Cash has gone out from the business. So it's a minus. Ramji Lal, what has happened to this liability? Which means the fact that we owe money. Has our dues increased? It has, right? We have to pay money to Ramji Lal, and which is a liability. Has the liability increased? Yes. By how much? 1,15,000. Don't get confused. Your cash balance hasn't increased. Your bank balance has not increased, but your liability, which is what? How much money you owe to someone. The money which you owe to someone has increased. By how much? 1,15,000. To whom? To Ramji Lal. Okay, so it is a plus. So this asset is a plus, this is a minus, and this is again a plus. So let's check the rule for liability. If a liability increases, plus means what? It is increased, correct? Let's go to the rules. So when, let's check liabilities now. We have always been checking this assets, now liabilities. If liability increases, what do we have to do? We have to credit that. Okay. So now we know that in our example here, in the case of plant and machinery, we have got more plant and machinery in the business by buying, by purchasing, right? So, and plant and machinery is an asset. So when an asset increases, what do? We have to debit it. So plant and machinery, debit. How about cash? Cash has gone out from the business, 10,000, and it is also an asset. So we have to check asset and decrease. What happens? It has to be credited. So the cash account has to be credited. And we've already checked that Ramji Lal, the last account, in this transaction, Mrs. Ramji Lal has to be credited. So now we know what needs to be done with the journal entry. So we have to write it this way. Plant and machinery debit. By how much? 1,25,000. 2. There are two accounts which have to be credited. Cash as well as Ramjilal, right? So first I'll write to cash. Cash, how much was the amount? 10,000. And there's another 2 because there are two accounts to be created. Okay, to Messrs. Ramji Lal. How much is that one? That is the balance, 1,15,000. So this is the journal entry now for this transaction. For this particular transaction, this is the journal entry. Fine. Plant and machinery debit, 1,25,000. Sorry for the writing again. To cash. How much was the cash payment? 10,000. And how much is the liability? Gone up by 1,15,000. So this is the entry for that. And this is an example where there were 3 accounts involved and not only the minimum of 2. Okay, fine. Let's go back. So now let's start off. We have already discussed example 1 is done, 2 is done, and 3 is done. Now, before I discuss about example 4 and example 5, these are very important because what will happen now? Now we are discussing about goods purchased and goods sold. Why is this important? I'll try and explain to you. Okay, let's go to the whiteboard. Okay, now why do I say that examples 4 and 5 are a little different from examples 1, 2, and 3? Here we have encountered for the first time the word goods. How does it make anything different? So in the case of accountancy, whenever you use the word goods, it means now you're discussing about the main goods which you sell in your business. Sell in your business. What do I mean by that? Suppose I am someone who has a store for clothes. I have a clothes shop. Okay. Now, if I'm talking about selling goods, I'm talking about selling clothes. If I'm talking about buying clothes, I'm talking about buying goods. I'm talking about buying clothes. So this goods word is used for the main business which the person is into. If you are a dealership, if you are a dealer for cars, for selling cars, then if you say that you have sold goods, that would mean selling cars. So the core business is what we are referring to when we are talking about goods. Till now, if you check the rest of the examples, I'll just go back to the slide. So what we had discussed, bought furniture. So bought furniture means we are buying something which is just it is not the main thing. We are not into the business of buying and selling furnitures. Something else is our business. This is not what we can term as stock or inventory. Why am I discussing all these words? Because all of these words are used only for the main business which you are into. When you're buying furniture, suppose you are someone who is into the business of selling and buying furnitures. You buy furnitures, then sell. So suppose you're a trader in furnitures. Then this will be what you call as your inventory or your stock. And we might also in accountancy say that you're buying goods and selling goods. What are the goods? It is furniture for you. If you are into the business of buying and selling furniture, it need not be buying. It can also be manufacturing. You might be a company which produces or manufactures furnitures and then sell it. So even then, in that case, this is your stock or inventory. Okay. This is buying furniture means you're buying it to use it in your office or use it in your factory, but this is not your stock. This is not what you're going to sell. Okay. You might sell it because it has become old. I'm not talking about that. But you're not into the business of buying and selling furniture is what I mean. Likewise, in the next example, if you check, bought plant and machinery. This plant and machinery is used by the business maybe to produce something. And that thing which this plant and machinery produces, whatever that thing is, it might be cars, it might be bikes, it might be bricks. I'm just saying. Okay, it might be anything. So whatever it produces, that is what will be your stock or your inventory. And that might be referred to as goods. Right? I think that makes it clear. So here in example 4 and in 5, we are talking about goods. So which means the main business, whatever we are into. We are talking now about what we can call as stock or inventory. Okay, I think that makes it clear in both of these example goods. Now, when you're talking about goods, we do not use goods account in journal entries. So which means in recording transactions, we do not use the name goods account. What do we use? If we are buying goods, we use the word purchase account. Fine, purchase account. If we are selling goods, we use the word sales account. Okay, so goods, we call it, if we are purchasing goods, which is our main stock or inventory, that account we call as purchases account. If we are selling goods, we call it as sales account. And then there are other accounts also for goods, like return of sales. Return of sales account, which means we have sold some stuff to our customers. The customers have returned it back, maybe because it's defective, maybe it is not up to the quality standards, whatever. So the goods account actually gets divided into all of these. I'll just make a list of the entire thing. Just 1 second. Let me discard all of this. Okay. So when we're talking about the goods account, I hope you don't mind if I put it here. The goods account gets divided into the purchase account, the sales account, the return of goods account, return of goods. So you've sold goods, that has come back to you. This is also called as return inwards. Return inwards. Why inwards? It has come back to your company. And then you also have Return of purchases. Purchases account. What is that? It is also called as return. You guessed it, correct. Outward. Because this is, you bought it and you have given it back. Return outward. So the goods account might be, not might be, it gets divided into all of these. Purchases account if you're buying goods, sales account if you're selling goods, return of goods if what you've sold has got returned, and return of purchases if whatever you've purchased, you've returned it back to your supplier. Okay, so goods. I hope that makes it clear. Now, these accounts, the purchases account or the sales account, will be used in the rest of the examples. That is why I thought it is important for you to understand the distinction. So, okay, let's think about it now. What might a purchases account, what might a purchase account be categorized as? Is it an asset? Is it not an asset? So suppose we'll assume for this example that we are into the business of bikes, buying and selling. We have a dealership. We have a dealership. What is a dealership? For a general purpose, you can think of it this way. You have a showroom, which is bikes. What you do, you buy bikes from the company, you sell it to customers. Okay, so you have a dealership in the business of bikes. So now let's think about it. You have purchased. What have you purchased? You have purchased bikes. Now, after you've bought the bikes, is it under your control? Yes. Is it as a result of past events? Yes, because you made a payment for buying all that, right? So that is the past event. Future economic benefits expect. Now, very careful about this third point here. Future economic benefits are expected. In this case, by buying the bikes, what has happened? Your inventory of bikes has gone up, right? What is the meaning of inventory? The number of bikes which you have in your showroom to make it easier for you. Or the stock. These are interchangeable words. This is synonymous. These two mean the same, at least for our purpose. Inventory and stock are the same. So the moment you bought the bikes, your inventory has gone up, right? So automatically, what has happened is you've already enjoyed the benefit. What is the benefit? Of because you're into business and your inventory has already become high because you've bought the bikes. So this word future economic benefits are expected. In this case, it might not be that you're expecting anything more. You're expecting to resell it. You're obviously expecting to sell the bikes now. But that is not what this is referring to. This is talking about the fact that you've purchased it. Is there any future economic benefit expected out of this purchase? Actually, there's no future economic benefit, but your benefit has already happened. You've already benefited because your inventory, because your stock has become higher. Okay, just be careful now. Let's try to distinguish this with something else. We have seen the example where the business had earlier bought plant and machinery. And we had categorized this as an asset. Now think about it. In the case of plant and machinery controlled by the business once it has bought it. Result of past event is again payment made. Future economic benefits are expected. Once you have bought the plant and machinery, and suppose you are into the business of now making bikes because you're buying plant and machinery, obviously you have to manufacture, right? Produce. So suppose you're into the business of making bikes. Then you are expecting future economic benefits by doing what? You'll have to use the plant and machinery, right? To produce, to manufacture bikes, to produce bikes, so that then you can sell. Correct? So in this case, future economic benefits are expected because Once you use it, then you have bikes, then you will sell them. Think of the example of, again, we have dealt with an example where your business had bought furniture. So the furniture, you bought the furniture, it is under your control, you made the payment, future economic benefits are expected. In this case, what is the future economic benefit? Again, you're going to use the furniture, right? For your office or for the factory, wherever you want to use the furniture, you're going to use it. So once you use it, that will be future economic benefits. But in this case, when you purchase bikes and you're a dealership in bikes, you've bought it solely with the intention to sell it off, right? You're not going to use it. So that whole thing about using it, you can always say that I'm using to sell it, but that is not using it. That is just selling it, right? So in this case, future economic benefits are not expected, but the benefit has already happened. You have already benefited. Because why? You've got more inventory now, and you're into the business of buying and selling bikes, and your inventory has gone up. So this will not, because of this point, it will not fit the definition of an asset. This one might confuse a lot of people. So as we go along, as you practice more, you'll understand. Okay, let's move on. Now, okay, does it fit the definition of a liability? The purchase account, does it fit the definition of a liability? Let us check it. This one should be easy. So once you have purchased something, is there any present obligation? No, because you have already made the payment. Result of past event? Yes, but you do not have to check all. If any of these is no, which means this is not a liability. Future outflow of resources are expected, again a no, because you have already got the bikes and you have made the payment. Correct? Okay, so this is not a liability. Is it capital? The money which the owners put into the business? Your business has bought bikes, but the owner has not put extra capital for that, right? So you're just using the business, which is you're just using the money which is already there in the business. So it is not capital again. This one should be very easy to understand. Is it an expense? Let's check. Is the purchase account an expense? Can it be categorized as an expense? And it is not a revenue, we already know. It cannot be a revenue because in the case of purchases, you're making payments. Revenue is when you get money by selling, right? So it is not a revenue. Is it an expense? Any payment which is either already made or is due for some economic benefit which the business has already enjoyed. So we discussed that this cannot be an asset because you've already benefited, right? So which means if you hit now, in the case of expense, any payment which is already made, you've already made the payment to buy the bikes, to buy this for your dealership, you've already made the payment, right? Already made. Or it might also be due that you haven't made the payment. But what is important here in the definition of expenses is some economic benefit which the business has already enjoyed. In this case, what is the economic benefit? That you've bought more stock, that you've got more inventory. The amount of inventory which you have, the amount of stock which you have, which in your case is bikes, has gone up. So you've already enjoyed an economic benefit. Because the inventory is more, now you'll be able to sell that, right? So which means purchase account fits the definition of an expense. Fine? Okay, let's move on now. Now we'll also have to think about which definition would the sales account be categorized as? Sales account, which category does it fall under? Sales in terms of money is the same as revenue, right? So we not even have to check. Whatever is our business, if we are selling our stock or inventory, the main business which we are into, in our case, we have just assumed that is selling and buying, correct? We are purchasing bikes and selling bikes, correct? And the money which we are getting by sales is what is called as revenue. So sales automatically has to come under the definition of revenue. Any money which has already been received or has accrued due to the outflow of the entity's economic resources. What will be the entity's economic resources is when you're selling bikes. So the bikes are flowing out, right? So outflow of the entity's economic resources. Either you have received or has accrued. So you might already have got the money or you're going to get the money. Because of what? Because you're selling. Okay. So sales falls under revenue. It is categorized as revenue, but that is obvious. Okay. Now let's go to the example. Now that you know all of this, let's go back to the fine. Now, so let's get into this example number 4. Okay, we'll do this now. Goods purchased from Messrs. Sumit Traders for rupees 55,000. And you'll notice the word cash is not mentioned. Whenever the word cash is not mentioned, which means goods has been purchased from this supplier Sumit Traders for credit, which means you haven't made the payment as of now. And the payment has to be made at a later point. Later time, the payment will be made. Whenever cash is not used, you know it's a credit purchase which has happened. Okay. Now, so we know that the word purchase is here. So one of the accounts will be, like we discussed, the purchase account. Fine. And the other one, there's no cash, but there's this payment which has happened for 55,000. We know by now the other account will be Messrs. Sumit Traders. And we have to make a payment to Sumit Traders, right? We have to make a payment to them. So what will this Sumit Traders account be? We already have discussed at length that the purchase account will be an expense. Correct? How about Sumit Traders? So which means we've already read the transaction statement and identified the accounts. Now we are trying to categorize. We are trying to get into this step now and categorize the Sumit Traders account. Okay. Fine. Sumit Traders account. What has happened? Is it an asset? Let's see. We have purchased goods. Okay. We have purchased the goods from Sumit Traders, so we have to make a payment to them, which means because we haven't paid in cash, we have to make a payment at a later stage. Is it something which is controlled by us? Actually, it is under Sumit Traders' control because the payment has to go to him. The payment has to go to Sumit. So this whole thing, if you think about it, we can always say we control it because we'll not make the payment, or the payment is actually under our control. But legally speaking, Sumit Traders has to get the money, so they've got the control. Okay, which means this point might not be correct, and it is not correct. Result of past event, let's not check this because this is because a transaction has happened, right? Payment has been made, or not the payment has been made, we've already got delivery. So result of past events. We've got delivery of the purchases which we have made. Future economic benefits are expected. In fact, that's a no, because we have to instead make a payment. We have already got our goods, right, from Sumit Traders. So nothing is expected in the future. Instead, we have to make a payment. There's an outflow which is going to happen. Correct? So this is also not correct. So Sumit Traders cannot be an asset. Is it a liability? Let's think about it. Is Sumit Traders a present obligation for us? Yes, we have to make a payment of 55,000 at some future point, but it's a present obligation, although the payment might go in the future, but it's a present obligation, which means legally we are bound to make a payment to Sumit Traders even at this point. It doesn't mean we have to make the payment today, but it means we have a payment to make. That is already established. That is already there. So present obligation is there. Result of past events. What is the past event? That we have got the goods, the delivery of goods from Sumit Traders. Correct? That is why we have to make this payment. Future outflow of resources are expected, isn't it? What is the resource in this case? The resource is money. How much of money? 55,000. So Sumit Traders, which means fits the definition of a liability. Okay, so we have established this. So now we know that in this example of ours, which we are doing, we know that the two accounts which are involved is Sumit Traders account and which is the other one? The other one is purchases account. So we know which are the two accounts which are involved. And in this case, we know that our obligation to make a payment has gone up in the case of Sumit Traders, correct? We have to make 55,000 rupees of payment, which means our liability has gone up. This is a liability, and the liability, the fact that we owe money and how much we owe has gone up, correct? Purchases account. We've already categorized this as an expense. Now, so we have to go to the final. We've already done apply the rules of debit and credit. Okay, so let's go to the final slide. So purchases account. We have categorized it as an expense, right? Expense. So we'll have to check here expenditures and losses, and our expense has increased, right? Because we have to make a payment. So which means we'll have to debit this account. So this is the account which will get debited. Shorthand DR. Okay, which is the other account? Mrs. Sumit Traders. And that one we have categorized as a liability. What has happened to the liability? It has increased, right? So we'll have to check here. When a liability increases, what do? We have to credit that. So this will be credited. So what will be the entry? Now we know. Purchases account debit by 55,000 to Sumit Traders account. Fine. So this will be the journal entry which will be made. Okay with this example? Okay. Let's now go to the last example. Fine. So now let us go to the final example, which is example number 5. Goods costing 25,000 sold to Rajani Enterprises for 35,000. So we have this word goods here. So which means we are dealing with our inventory, our stock. Sorry, our stock, like we have discussed. So we have just assumed that we're into the business of buying and selling bikes, right? So goods costing 25,000 sold. So which means one of the accounts which is involved is the sales account, correct? Because the word sale is there. And it is sold to whom? To Rajani Enterprises for 35,000. So again, you'll find out that the word cash is not mentioned here. The moment the word cash is not mentioned, which means this is a credit sale which has happened. So we have sold it to Rajani Enterprises and the payment will be made in the future. We have got that understanding. It might be made in 1 day, in 10 days, it doesn't matter. We have an agreement with Rajani Enterprises and a credit sale has happened. How do we know it's a credit sale? Because the word cash is not mentioned. Whenever the word cash is not mentioned, you know it has to be a credit sale. Okay. So now we know that Rajani Enterprises is the other account which is involved. Okay. Now it is given here that the goods costed 25,000. We are selling it to Rajani Enterprises for 35,000. That is our business, right? We'll have to sell it at a profit. Now this profit which we are making for this particular transaction, okay, do not confuse this with profits which you make while disposing assets. What do I mean by that? Suppose you bought a plant and machinery or a car for some purchase price, and later on you have sold that car for a amount which is higher. You have made profits. That profit is different from this profit. Why? Because here we are into the business of buying and selling bikes. We've just taken the example of bikes. We are buying and selling bikes. So that is our business. So this profit which we make, that is different from the profits which we make when buying and selling assets. And so this profit and loss account will not be used for this particular transaction. I just try to clarify that. I just try to clarify what I'm trying to tell you. Okay. Just clear this off. Okay. So suppose we enter the business of buying and selling bikes. Okay. But we have bought some furniture. For 20,000 rupees. And later on in the year, we have sold the furniture. We have sold it. This is cost. And this is, we have sold it for 30,000 after a year. We have found a customer who is willing to buy it at 30,000. We have sold it. We have made profits of 10,000. In this, you think about it. Our business is of buying and selling bikes. We'll buy and sell bikes. Our business is not buying and selling furniture. But because we bought some furniture and we did not need it later on, we had not bought the furniture with the intention of making profits by selling it, but we have sold it all the same. And we have made profits of 10,000. In this case, the profit and loss account will be used in the entry. But when we are selling and buying bikes, which is our main business, then this profit and loss account, we don't have to use it, because you'll find out later on that the profit and loss account already accounts. So the format of a profit and loss account is something like this. Just to take you a little forward, we'll cover all this at a later point. Okay, this is the debit side, this is the credit side. This has what you call as revenue or sales, correct? And this will also, this side will have all the expenditures. all the expenses which you make to get this bike. So, and the balance of this account is what you call, suppose the revenue is 1 lakh and you have made expenses total of 0.5. This is the cost at which you bought the bike, your transportation expenses, all kinds of expenses will be listed on this side. Now, this 0.5, which is the difference between this side and this side, will be the profit automatically. Okay. So the balance of this account is what shows the profit, right? So separately, you do not have to, while buying and selling the main product, the business of which you are into, you'll not have to account for this separately, the profit, because it will already come in the final balance. Okay. But when you are selling and buying something else, let's say furniture, what will happen? That gain you'll have to show. If it is a gain, you'll have to show on this side. If it is a loss, you'll have to show on the other side. That has to be shown. But this is already, because the expenses is already there. The revenue is already there. And this balance is what will finally show whether there's a profit or a loss. So you'll not have to make a separate entry. If you're confused with this for the time being, just keep it there. So, okay, these are the two accounts which are involved, sales account and Rajani Enterprises. Now, sales account, sales means what? Revenue. So this is automatically categorized as a revenue account, right? So we don't have to check it separately. We have to check what kind of an account is this Rajani Enterprises. Okay, let us check. So we are trying to check if Rajani Enterprises is an asset. We expecting payment of how much? 35,000 from Rajani Enterprises. Is that controlled by us? Yes, because legally we are entitled to that payment of 35,000, right? So we control that from Rajani Enterprises. That payment which has to come, we control that legally. Correct? Okay. Result of past event. What is the past event? We have delivered goods to Rajani Enterprises. We have given them goods, right? So that is the past event because of which we are expecting this money. Future economic benefits are expected. Yes, because we are expecting payment. We are expecting money, which means Rajani Enterprises fits the definition of an asset. Correct? So now we know this is an asset. So let's go to the final slide. So here we know there are two accounts which are involved. One is sales account, and we know sales is automatically revenue, and we have done more sales, so sales has increased, so which means we have to credit the sales account. Which is the other account? Messrs. Rajani Traders. What kind of an account is this? We have checked that it's an asset. Correct? This is an asset. What has happened? Has the asset gone up? Yes, because we're expecting a payment. So which means if an asset increases, we have to debit it. So now we know what shall our entry be. Messrs. Rajani Traders account debit by how much? 35,000 to sales account. How much? 35,000. Fine. So that completes our example of the journal entry. Now to finally show you all the entries in a single page in fair copy. This has all of the entries. And this is in the proper format in which a journal will be kept.